Hey, good afternoon, everyone. Welcome to the Federal Tax Update, Part 2. My name is Dan Mayo. I'm a partner and I lead the National Tax Services Group here at Withum. I'm a lawyer by training, but I've been avoiding practicing law for a long time now. And so I specialize in at Withum, in a broad range of tax issues. Spent a lot of time in the M&A area, qualified small business stock, employee retention credit, and audits, and also general tax matters. So today we're going to talk about, I know Lynn mentioned last week, you heard Lynn talk about tax credits and the OBBBA or OB3, a lot of tax updates relating to that. So we're going to move away from that today and cover an entirely separate area of the tax update for the year. And we're going to talk about some cases that have come out. We're going to talk about some developments from the IRS that have come out. And so we got a broad range of things. And one thing about the OB3, what I call it, call it OB3 because whenever I say OBBBA, I wonder if I missed a B somewhere. I think a lot of us do that. So I'm going to talk about OB3 only in the context of qualified small business stock, and Lynn and I coordinated that, so we didn't duplicate. She intentionally left that off last week, so we didn't cover that. So that's the only thing I'm really going to focus on for OB3 today. Mostly going to be updates that have occurred throughout the year, either both from the IRS and on the case law side of things. Okay, also the tax data book, which I love talking about because I think it's interesting and people see that. So some stats about the IRS, what happened this year. We'll talk about overview of the IRS and then get into the cases. So the IRS collected nearly by the way, the IRS publishes a data book every year. The fiscal year 2024 data book is the latest one that came out. So that's what we're focusing on. Obviously, it's backward looking. It does not include 2025. So it's a little bit backward looking, but it is the most recent data. So the IRS collected nearly 5.1 trillion in gross taxes last year, up from 4.7 trillion in previous years. I'm going to show you some graphs in a few moments on the later slides, which will show you the significant uptick in since COVID, pretty much. They processed 266.6 million tax returns and other forms. That's a lot of forms. So a lot of that's electronic. It's not all paper, so it's easier in that regard. They issued 120.1 million refunds. That should be a million there, totaling $552 billion. So, significant activity going on. They answered 20 million live phone calls, and the IRS.gov received more than 690 million visits, although a large chunk of them were people trying to find that elusive "where's my refund" button. So that's out there, and that's a big one at the IRS. Where's my refund? In terms of the audit side, the IRS examined audit rates that we know have been low, right? They've always been low. They certainly are going to get lower in 25 and in at least the next couple of years. They increased. The Biden administration had passed the Inflation Reduction Act 2022, which had earmarked significant funds for enforcement. Those funds have been pulled largely, which is why we're going to see audit rates decline even further. But looking at the data here from 24, the IRS examined 0.4% of individual tax returns and almost 8% of returns of individuals who reported 10 million or more in income, and 0.66% of corporate tax returns. So, about 0.5% on average is the audit rate. So very, very low audit rate. And that's obviously expected to decline in the coming years. And of course, these stats don't take into account the large cuts to the IRS staff in 2025. Obviously, they can't be reflected in these numbers, but on average, about 25% of the IRS has been cut. So significant cuts to the IRS, including a lot of senior people. So a lot of institutional knowledge has departed, and will leave the IRS in a slightly weaker position, but not in a position where they're incapable of doing their job. So we talked about that 5.1 trillion in gross receipts. If you look here, you can see things started to pick up in 2020 around COVID, right? That's when the receipts started jumping. It was about 3.5 trillion roughly, and it jumped up to that 5.1. So we're talking about now right here. So that's fairly significant. And then when you look at the totals, we'll have percentages on the next slide. You see here the individual tax is a fairly significant portion of it. It's about 55%. Next is employment taxes, which is this blue section here. And then you get corporate tax, which is this orange section. So corporate tax is really a small piece. We spent a lot of time talking about corporate tax. Here it shows on this slide here, the business income here. you can see it's $500 billion on 5 trillion total, right? And so it gets a lot of attention, but it doesn't raise that much revenue for the IRS. So when you think about tax reform and you hear about it all the time, I think these stats are useful to remind people that it's the individual taxes that make up the bulk of the collections at the IRS, and so that's what they need to adjust if they want to raise revenue or raise significant revenue from for the fisc. Okay, these are the stats I was mentioning. You see total collections here of about 5.1 trillion. On the corporate side, it looks like it's about 11%. Individual side's about 55%. Employment taxes are 32%, and state and gift, makes up 0.5%. And excise taxes take up 1.5. That's obviously the excise taxes that probably includes the tariffs that's likely to increase in 25. But again, I think this is useful. It shows the significance of individual taxes at almost 55% of total collections at the IRS. And while it's important, the relative insignificance of business taxes, right? Corporate tax. You see employment taxes, I think that's a shocking number for a lot of people to see this, the large portion of revenue that's raised through employment taxes. We talked about that 266.6 million tax returns and other forms that are filed. Again, a lot of that's on the individual side. If you look here, that includes all of this, right? The paper returns are in these diagonal lines, and the solid green is electronically filed. So the bulk of it's electronic, some of it's paper. But of that, of the number 200 million of it is of the 266 is individual returns. So you have a large number there. The employment tax makes up the next biggest chunk right here. And then you get into business tax return, again, a smaller portion. And these percentages are roughly consistent with the collections. The National Taxpayer Advocate also produces a report. They produce 2 reports a year. National Taxpayer Advocate's an office within the IRS that helps taxpayers, and they report on a lot of issues. They advocate for taxpayers within the IRS. So if you have a problem and you're not getting someone at the IRS to help you with it, you file what's called a Form 911, like the telephone number. And that form requests assistance from the taxpayer advocate. And I've used it before for clients, and it's helpful. Someone will contact you, and they can help facilitate moving things within the IRS. It is useful, but they've experienced significant cuts, about 25% this year. So this shows personnel losses as of June of this year. Obviously, there were cuts since then. So why is this significant here? The appeals office within the IRS lost 28% of their staff. That's a pretty big number, right? Chief counsel's office gives all the legal advice to the IRS agents and all the guidance that comes out, down 13%. Online services down 55%. So a lot of cuts here in the government, the small business self-employed division, 35% down. Taxpayer advocate, who produced this report, down 25%. Taxpayer services are down. Whistleblowers offices down here at the bottom, got cut by 26%. So I mean, every division in the IRS took cuts, and that's on average about 25%. I think some of these divisions with large cuts are smaller number of employees. Here's the total on the bottom. They went from 102,000 down to 75,000, so about 25.86%. I mentioned here we're going to talk briefly a little later on about some changes with regard to the employee retention credit. This because some guidance came out this year, some FAQs and Q&A, and so you can see the claims. This goes down here as time goes on, 2020 to 25. The claims processed in each year, it spiked up to 1.5 mil in 2022, and then it dropped each year since. And the claims paid similarly spiked in that same year to 99.1 billion of claims paid. It's interesting that they estimated, I think it was like 85 billion would be the total ERC. When they passed the ERC, the amount budgeted for the cost of the ERC was about 85 billion. Then they got rid of Q4. That took a chunk of it away. Q4 of 2021. And, they've already spent, if you look at these numbers, it's about $250, $300 billion, sorry. So, well in excess of what they budgeted for the program. Okay, I talk a little bit about the IRS Commissioner and Chief Counsel. Again, more change to the IRS. On January 20th this year, before Trump was inaugurated, Danny Werfel resigned. He was the 50th IRS Commissioner, and in June of this year, Billy Long was confirmed. He was nominated on January 20th, so I put that in there to show the, it's about 5 months from January 20th to June 12th for for the confirmation hearing and to get Billy Long confirmed. He was a Republican member of the U.S. House of Representatives from Missouri for quite a bit of time, 12 years. He had little tax experience and no experience really running a large organization. He was supposed to serve out Danny Werfel's the rest of his term, which would have taken him through November of 27, so about 2.5 years, roughly. But that didn't last. After a few months in the job, he was removed on August 8th. So Long is out, and then Scott Bessent came in. Bessent, obviously the Secretary of the Treasury, is the acting commissioner. I think he's the 7th commissioner or acting commissioner we've had this year, including Danny Werfel. So there were a couple actings in between from Werfel to Long, and then after Long was essentially pushed out, Scott Bessent took over. So he's managing Treasury and the IRS. IRS is a division of Treasury, so it's not entirely odd that you have Scott Bessent managing it. Don Korb on the chief counsel side was nominated in June to serve as IRS chief counsel, and he was confirmed in October. He was I've met Don before, a very nice guy. He was he'd been in this role in the past. He served under Bush II from 2004 to 2008. He spent his time since then at Davis Polk, a big law firm in New York. So he spent a lot of time there. I think he was exclusively from at Davis Polk. I'm not certain of that, but he's back in chief counsel's role at the IRS. Okay, so let's turn now to some cases. We'll talk about some developments that have happened in the courts regarding taxes. The first is this Actavius case, Actavius Labs in Florida. And this deals with a taxpayer that was defending their right to sell generic drugs. And so they were filed drug applications to make generic drugs. They were sued. And so they incurred expenses under this Hatch-Waxman law to defend their right to issue the generics. And they deducted them rather than capitalize them. And the IRS said you should have capitalized them into your generic drug application. Taxpayers said no, this is unrelated to that. And so in the way it works with these drugs, they had filed an abbreviated new drug application with the FDA to seek approval to sell their generic drugs. In response to the manufacturer of the branded drugs sued them for patent infringement under the Hatch-Waxman Act. And so I understand it's fairly common for generic drug manufacturers to be sued. It's a fairly routine practice in this world because the branded drugs want to extend their monopoly for as long as they can. So the taxpayer, this Actavius, deducted their litigation costs in defending itself in those suits. It took them as ordinary necessary business expenses. The IRS objected. They audited them and disagreed. And the IRS said that they should have capitalized those expenses and then presumably deducted them over time, right? Amortized them over time, because they were incurred in pursuit of an intangible asset, which is FTA approval. They said that's part of your approval process. Defending yourself in litigation is part of the approval process to getting that ANDA, or that abbreviated new drug application. The trial court, the trial court held that litigation expenses were deductible, so ruled in favor of Actavius. They do not need to be capitalized, and the Federal Circuit Court of Appeals affirmed. And that's what this latest case is, the Federal Circuit Court of Appeals that happened in March of this year. So if you look at either the big thing with litigation expenses, you look at the origin of the claim test. What's the origin of the claim that gives rise to the lawsuit, and that determines deductibility. Or there's a very significant future benefit test to determine whether you capitalize something. If there's a significant, future benefit in incurring an expense, then you would capitalize it because it's, the expense relates to many years. So they want you to capitalize it and then amortize it over the course of many years, taken into account over a multi-year period. But the taxpayer said they were ordinary necessary under either of those tests. Regarding the origin of the claim test, the court said that the claim originated in patent infringement, not the acquisition of FDA approval. So they separated them out and said there's an approval process, and then there's defending yourself in a patent infringement lawsuit. They're two different things. Regarding that second test, that significant future benefit test, which is down here, the court concluded the litigation was not part of that process. So, and this court's decision is consistent with another case from 2023 in Mylan Pharmaceuticals. So, more developments in this area that which is helpful for pharmaceutical companies, especially the generic manufacturers, that the costs of defending themselves can now is clear that it's deductible now that we have the Federal Circuit ruling on the issue, in addition to the Third Circuit over here. Okay, the next case we're going to talk about is also a drug company, AbbVie. And so this case came out in June of this year. Tax court issued an opinion relating to a failed merger agreement. So this deals with merger termination fees. So AbbVie had entered into an agreement with Shire Pharmaceuticals, an Irish pharmaceutical company, and there was a breakup fee. And as it turns out, the merger was abandoned a few months later because the IRS issued guidance targeting inversion transactions, meaning when companies outside the U.S. want to come into the U.S. And so that notice 2020-14-52 killed the deal. The parties were evidently under that impression. So the termination fee was due. So AbbVie paid the termination fee. And much like the taxpayer in the last case, they took it as an ordinary deduction, allowing for costs for an abandoned capital transaction under 165A. The IRS took a different position in the last case. They didn't say it should be capitalized. They said it was a capital loss. So the taxpayer took an ordinary deduction. The IRS wanted to claim it was a capital loss, which obviously would have limited it significantly because corporate taxpayers can only take capital loss to the extent of capital gain. So the IRS cited 1234 Cap A, which is a section that was intended to reverse the extinguishment doctrine. I think it came in a long time ago. Certainly it's been in decades. That provides for capital gain or loss on the termination or cancellation of a right or obligation with respect to property that's a capital asset. And so that's the question in this case was, did 1234 Cap A apply? The court said it did not. So the court ruled tax court ruled in favor of AbbVie. Said the termination fee was not tied to a property right because the stock it would have been transferred in the merger, was owned by the shareholders, the public shareholders who had ultimate authority to approve the deal. And they gave an example, which I put here in the slide, why they said 1234 Cap A doesn't apply. In addition to Pilgrim's Pride, which we'll talk about in a moment. But they said if a worker enters into a contract with a property manager to wash the windows of a skyscraper, so you have an employee enters into a contract with the manager of a skyscraper, not the owner, but the manager, to clean the windows, and the manager pays a fee to terminate that contract to the worker, right? So typically that'd be ordinary income. 1234 Cap A would not convert that ordinary income into capital gain because neither party owns the skyscraper. In other words, there's no payment with respect to property that's a capital asset owned by either party. So that's why the court ruled the way it did and said that in this case, the stock was owned by the shareholders who had ultimate authority to approve the deal. So this opinion limits the scope of 1234 Cap A, which is helpful for taxpayers. They prefer ordinary loss rather than capital loss, and eases the sting of a failed M&A transaction. So now breakup fees, it's certainly clear after this decision that these breakup fees can give rise to ordinary deductions. And this decision follows the 2015 Fifth Circuit opinion in Pilgrim's Pride, which is a popular case when it came out at the time, where the court had held that 1234 Cap A only applies to termination of rights with respect to a capital asset. Same thing is going on here, and not to termination of the capital asset itself. And so that was an interesting case because the taxpayer in that case had stock that they didn't want. It was worth about $20 million. They could have sold it for $20 million. And instead of selling it for $20 million, they abandoned it and took a loss, an ordinary loss of $100 million. So they said, I don't want the $20 million. It's more valuable to me to take that ordinary loss of $100 million. And the alternative was to receive $20 million in cash and take an $80 million capital loss on the stock. And so I guess they had no capital income. They couldn't use that loss, a capital gain rather. So they chose to abandon the stock, even though it was worth $20 million. And I think that's what got the ire of the IRS and why they pursued the case so harshly. And the court said, no, the stock itself is not a right or obligation with respect to a capital asset. The stock is the stock. The IRS tried to come up with some creative argument saying, no, there's rights inherent in the stock that relate to the assets of the company. And the court didn't buy it. The court said, no, this refers to like an option, right? A terminate an option or something like that, or a contract with regard to capital stock. So they want to see a contract right referencing some kind of capital asset. You don't have that with the worker in the skyscraper because they don't own that capital asset. You have that when you terminate, say, a contract with regard to stock. So now you have a contract that references a capital asset, but not the capital asset itself. So that this AbbVie case is consistent with that 2015 case in Pilgrim's Pride. Okay, the next case we have here is Savage. This case came out recently in September of this year, and it's a tax court case. And they ruled that wages that are not deductible under 280 Cap E, in this is regard to cannabis, right? This is largely cannabis. If you traffic in a Schedule 1 or Schedule 2 substance under the Controlled Substances Act, then that's considered, you're not allowed to take that deduction. And so the question was, if you couldn't take that deduction for 280 Cap E, can the taxpayer slip it into the QBI calculation under 199A? So they said, I realize 280E bars me, but now I'm going to do my QBI deduction under 199 Cap A. And remember, there's a wage limitation in there. So you can deduct your QBI deduction to the extent of your wages that were paid. And so they said, even though it's not deductible for 280E, it's still a wage for purposes of 199 Cap A. So that was the issue in the case. The court didn't agree with the taxpayer is the short answer. But this case involved a bunch of shareholders in S corps. There were 2 or 3 S corps. I think 3 total, but 2 of them were at issue. And then that's what they did. They claimed a deduction, even though they acknowledged 280E barred their deduction because they were dealing, cannabis is still Schedule 1 drug. There's talk of rescheduling that. This almost happened in the Biden administration. Recently, the cannabis stock spiked about 2 months ago because Trump made some statements at a political event suggesting that he might reschedule cannabis. So the talk is rescheduling cannabis to Schedule 3 instead of Schedule 1. And if you do that, it's 280E won't apply, and then all these companies can deduct their expenses, and the market for cannabis companies will take off. So that's the issue in the case. The court said no. If you can't deduct the wage expense under 280E, it's not considered wages for purposes of 199 Cap A. Okay, next case we'll talk about is the Schliefer case. This is a case in Florida about the variance doctrine, which is a doctrine that prohibits a taxpayer. If you argue something and you go fight with the IRS and you argue over an issue, you can't raise new issues in tax court. That's what the variance doctrine says. So it prohibits a taxpayer from making a new legal or factual argument in a refund case that they didn't clearly assert before the IRS. It kind of makes sense, right? You want to give the IRS a chance to a full and fair opportunity to resolve the issue before they go to court. You don't want the taxpayer holding their good issues back, arguing one thing before the IRS and then arguing something totally different in court because the IRS didn't have a chance to consider that issue. And so the variance doctrine is what was at issue in this case. This is a wealthy couple where the husband was, I think he was a hedge fund guy. He bought a plane, he bought a $20 million fractional interest in a jet. He took a deduction of $2.6 million for the expenses, but then they amended their tax return a couple of years later. They inadvertently neglected to deduct about $6 million in depreciation on the jet. And so on audit, the IRS disallowed the refund claim for the $6 million deduction. And the Schlieffers had their accountant represent them in the audit. Generally not a problem. This accountant apparently was not well versed in representing taxpayers in audits, and that's what gives rise to the problem in this case. So the accountant spoke to the agent and explained orally, but didn't put it in writing that, look, they made a mistake. They put it on Schedule C of the tax return for business expense when they didn't use it in the business. It should have been a Schedule E, which is an unreimbursed partnership expense, because he was a hedge fund guy, worked at an investment partnership, and it was an expense in connection with that. And so no one disputes that the amount was incurred, that's the appropriate amount, and no one disputes they would have been entitled to a deduction. The question is, can they argue they meant to put it on Schedule E when they didn't clearly assert that before the IRS? And that's the issue that the court considered. So the IRS, and what makes this case even more interesting is that the agent agrees the issue was raised. Right? The agent here noted the conversation about Schedule E versus Schedule C and acknowledged that the deduction might have been valid if been claimed on Schedule E. But the taxpayer never submitted anything in writing to the agent on that point. And what bothered the court about this was the court said, had you told this to the agent, he would have asked more questions, right? The agent would have asked different things that he didn't ask because you told him it was Schedule C. So the court agreed with the government and said, much to the taxpayer's chagrin, depreciation deductions would have been valid on Schedule C, right? Only if it was used in the conduct of a trade or business, which it wasn't. But then the court said, we're not going to consider whether it was proper to put it on Schedule E because the variance doctrine prohibits us. So they lost their opportunity to litigate an issue where they likely would have won had they asserted it on audit. And so it's a harsh result in this case, and one that's sort of hard to swallow. But that's the rule, right? And apparently when you're at the IRS, one of the first things you always do is a variance review to see if the arguments the taxpayer raising were asserted down below at the administrative level. So the Schlieffers could have claimed a deduction on their Schedule E, again, but their entitlement to that would have required them to bring forth additional proof, such as whether the agreement required him to pay expenses out of his own funds. So a very harsh result. But it's a good reminder to all of us to have an experienced controversy advisor when contesting an issue with the IRS. Using the accountant who signed your return may be a good idea, it may not. But I think the question you should ask is, does that person have experience in tax controversy matters? Are they aware of the rules? It's not just a matter of arguing the technical merits of your case. So good reminder to us all to make sure you have the right person for the right project, right? The person that was great to prepare the returns may or may not be the right person to represent you in contesting or challenging if the IRS challenges that return. All right, the next case is the Kelly case, which is Kelly versus Commissioner. It's a Ninth Circuit case. Came out in June of this year, where they agreed with the tax court, but it's a bad debt deduction case under 166. The question was a debt worthless? If a debt's worthless, the taxpayer gets a deduction. Taxpayer never proved worthlessness, though. The taxpayer said, well, the debt was discharged, therefore it was worthless. And that's where the court disagreed. The court said, no. Discharge means, and I put that in here somewhere, worthless means lacking in value or utility, and discharge means release from a payment or an obligation. The taxpayer, since they never proved worthlessness at the trial court, tax court, they tried to say that, well, the debt was discharged, therefore it was worthless, right? It was discharged, ergo worthless. And the court disagreed. The court said, no, those words are not synonymous. Just because a debt was discharged doesn't relieve you of the obligation to prove it was worthless. Section 166, governing bad debts, does require you to prove worthlessness. And so just as a reminder, to claim a bad deduction under 166, you must establish three things. One, the debt's bona fide, it's a valid debt. Two, you have an adjusted basis in the debt sufficient to claim a deduction, meaning you loaned money or out of pocket. You have an actual economic outlay. And the third is that the debt became worthless during the year. That's the key, within the tax year. So if it became worthless in a prior year, you don't get a deduction in the current year. If it's not worthless in the current year, you don't get a deduction because it'll be worthless in a later year. So that's the issue here. The taxpayer lost. They said, the court said, although a debt might lack value at the time of discharge, you have to prove it, right? The issue is worthlessness, not whether it was discharged. And so even though a debt was discharged, it doesn't relieve the taxpayer of proving it was worthless, which is the actual requirement in 166. And then I got an interesting quote here from the court I put on the bottom. They said, without objective, credible evidence demonstrating worthlessness, any monetary transfer could be characterized as a loan and later canceled or discharged to produce an illegitimate tax benefit to a putative creditor. Congress enacted an objective test of actual worthlessness to subvert this risk. And so that's what went on here in the Kelly case. you do need to prove worthlessness. It's a good reminder. A lot of times we talk to clients about worthlessness of bad debts in 166 or worthlessness of stock under Section 165. And just want to remind you, there are two different standards. You can get a partial worthlessness deduction under 166. Under 165 for stock, for example, it has to be wholly worthless. So, no value and no future value. Okay, next case is this Bank of America case dealing with a merged entity. Two corporations merged in 2013, and what the taxpayer tried to do here was a netting of interest. So they pay, the two entities come together, and what they said was, well, one of these entities pre-merger paid interest, another entity pre-merger received interest, so we should be able to net them. And they wanted to net them. The court said no, it doesn't work that way. They weren't the same taxpayer at the time they paid or incurred the tax. So the interest netting rule applies only when the tax underpayment and the overpayment are made by the same taxpayer, right? And so the merger didn't render them the same taxpayer in the year at issue in 2013. They were merged later on. So that's small point, but I thought it was an interesting case. I thought I'd talk about it. Question came in, which I see on the chat. How could a debt not have been worthless if it was discharged for zero? It's a good question. And that's what the court dealt with. And the court said that, they said, look, it may have been worthless, but you got to prove it. And so remember, the taxpayer has the burden of proof on deductions. And so the court didn't necessarily disagree that it was worthless. It might have been. They said it might have been. We don't know, but you got to prove it. And so the point is the taxpayer didn't prove it, and they tried to say, well, if it discharged, it's got to be worthless. And the court said no. And that's that quote. I said, here, you got to objectively demonstrate it, because otherwise you could just characterize something as a loan and cancel it. And the fact of canceling a loan means it's worthless, which is not true, because if you have related parties, you may want to cancel it even though it's not worthless, but you choose to cancel it because it gives you a tax benefit. And so that's the concern they had. But it's a good question, something the court actually considered and discussed. Okay, so we finished that question there. We talked about Bank of America, so let's move on to the next one. GWA LLC. This is an interesting case. This case came out in April of this year, and it goes back a long ways. This case has been brewing in the system for many years. I'll cut ahead quick. I'll give a shameless plug for an old article I wrote. The IRS ruled against this taxpayer in 2010. They came out with this advice memorandum, which I wrote an article about with a colleague of mine at the time, Sam Chen. Options over managed account. So this is not a new issue. This has been around for a while. What the taxpayer did was, they had a managed basket of stocks, right? And so if they're trading stocks all the time, they're going to have short-term capital gain. And short-term capital gain doesn't get a rate benefit, right? It's taxed as ordinary income, maximum 37% rate today. Back then it was 39.6. So managing a basket, so the taxpayer kind of repackaged it, and they wrapped it up into an option. So they used the option as a wrapper around this managed basket. So the hedge fund entered into 12-year call options with the bank over a basket of stocks that the fund dynamically managed over time. So the fund had full control, almost full control, to manage these stocks. And technically they needed the bank's permission, but the bank has no reason to withhold it other than risk limits, right? And exceeding what the bank thinks they won't get paid for. But so they had the ability to dynamically manage the stocks and receive the return under this call option. So, and I think that was a bridge too far for the IRS. And the IRS said, look, and this is what I wrote about in this article that I wrote in 2011, Tax Notes Today, that it's a bridge too far, that the fact that you have control over the stocks underlying in the basket, underlying the option, means you're the owner of the stocks. Either you have a 1001 event, and every time you trade, you have a new option, which is one way to incur short-term capital gain, or the option is not really an option. You're the owner of the underlying securities in the basket, and each time they trade, you have short-term capital gain or loss. So the fund was seeking, deferral and conversion. They wanted to defer the gain until they close out the option, and they wanted to say it's long-term capital gain. So deferral is one piece, conversion from short-term capital gain into long-term capital gain. worthy goal. People have been trying this for years. It comes up in a variety of contexts. Deferral and conversion is something everyone seeks. Not easy to do. In this case, it didn't. The court didn't agree. So I won't go through each of these factors, but the tax court listed 8 factors, differences between the options that they actually executed. I don't know why it's giving me these strange lines when I draw on this, and true options, like an option if you buy on the right, if you buy an option on the public exchange, call option, for example, it's a 3 years, 1 month, 2 months, 3 month. At most, you're going to go out as like a year or two for leaps, right? Those long term options. These are long term, 12-year options. It is not something you can replicate in the public markets. The taxpayer was managing the fund. The bank was hedging, but the taxpayer was dictating the stocks that underlie the option. So there's a lot of control by the taxpayer. And the court listed these factors, and these are the differences. Here, for example, had a 12-year term or more, which is unusually long for an equity option. The underlying basket was not clearly defined, and it was constantly changing because the fund had discretion to change them with little or no oversight by the bank. So if you think about it, you can do an option over the S&P 500, right? And that's an option over 500 securities that are changing that may change, not all the time, but it may change as the S&P changes it. But the taxpayer is not the one making those changes. It's the S&P organization, Standard & Poor's, is choosing the composition of those stocks in the index. So it's not because it's not the taxpayer doing it or the bank or one of the counterparties. It's an unrelated third party doing it for its own purpose. That doesn't give rise to a taxation event when they change the basket for like public options over the S&P 500. What the difference here was the taxpayer who was long the option had that full right to dynamically manage it. Okay, so that's GWA. It's also mentioned too that this was as a listed contract for a while. In 2015, the IRS issued 2 notices, designated them as listed transactions and a transaction of interest. Recall that listed transactions are the worst kind of reportable tax shelters. The IRS identifies them as saying these are a reportable transaction, which is another word for tax shelter. And transaction of interest is something that has the same effect of a listed transaction, but the IRS is essentially saying we need more information. Until we get that more information, we're treating it as a listed transaction. These notices were invalidated by there were 2 courts of appeals cases. I think it was CICC and Mann, if I remember, if my recollection is correct. They had the notices and other notices too were invalid under the Administrative Procedures Act, which is the APA. And then in December 24, the IRS announced it would no longer enforce disclosure and reporting requirements under the notices, those 2 notices here. In July of last year, the IRS issued proposed regs, right? Because the notices were invalid, the IRS still wanted to attack these things. So they issued proposed regs of last year, identifying them as listed transactions. And then in April of this year, the IRS obsoleted those listed transaction notices that the court validated anyway. So the IRS is going to get around to finalizing these regs to make them listed transactions. This has come up in a variety of contexts with micro captives and conservation easements where these notices have been invalidated by the courts. Okay, let's go to the next topic, which is qualified small business stock, a topic near and dear to my heart. So QSBS is, this regime came in 1993. It's section 1202. People refer to it alternatively as 1202 or QSBS, or qualified small business stock. The purpose of this was to incentivize people to invest capital, long-term investors, into new ventures and small businesses that historically had trouble attracting capital. The benefit is you get to exclude capital gain from gross income to the extent of the greater of a cumulative limit of 10 million or an annual limit of 10 times your basis. Pretty powerful stuff, right? So if you invest 5 million in a company and that goes up to 50 million, you can exclude 10 times your basis, so up to 50 million of gains. You pay no tax at the federal level. And many states follow QSBS. They conform to this provision. Some do not. Like California is one of the states that does not. New York does. And New Jersey does as of I think it's January 1st of 26. And so many states do conform. So tremendous benefit, right? You get to eliminate gain entirely. How often do you see that in the tax code, right? It's you have this pretty much. You have opportunity zones or another chance, but opportunity zones have a 10-year holding period, and you need capital gain to get into the QOF or qualified opportunity fund. This is just make an investment in a corp, 5-year holding period, and it gets you basically eliminating gain. There's a bunch of requirements here for QSBS. Only applies to taxpayers that are individuals and pass through, basically not C corps. You have to acquire an original issuance in exchange for money, services, or other property. So essentially, you can't buy it from another shareholder in a cross purchase. An original issuance doesn't mean the first issuance, just means you're getting it from the company and not from another taxpayer. Taxpayer acquired the stock after that effective date of 93 when it came in, and you hold the stock for more than 5 years unhedged. The unhedged is not really an issue because most of these are not public companies. There's no options market. There's no liquid market to hedge these securities. So you really would, it's rare that we see hedging in the world of QSBS. It's possible, but it's just rare that we see it. Issuer is a C Corp at issuance at the time the shareholder sells the stock and during substantially all the holding period. So this last piece allows the company to convert to an S at some point, as long as they go back. So if you have a company that's been around 7 years, they started out as a C Corp, they have 1 year as an S Corp, and they went back to C Corp, that can qualify because it was in a C Corp at issuance, at sale, and then also substantially all 6 out of 7 years. Substantially all is not defined, but somewhere between 80, 90%, probably a good guidepost to what it means. But S Corp stock can never be converted to C. So if you have stock in an S Corp, that's bad stock. You need to do some other structuring. There's other structuring you can do, but that's not going to get you there on its own. You can't just revoke the S election, go back to C, and then hope to qualify. The issuer had to have less than 50 million in aggregate gross assets at issuance and immediately after. A lot of people forget this "and" part. So the company must have less than 50 million at the time it issued the stock. So the company's been around, say, 3 years. You have a couple of founders come in at first. A couple of years later, they acquire, they grow the business. They have 10 million in assets. As long as they're under 50, they can issue more QSBS at a later point in time. The issue comes up when, let's say, they have 40 million in gross assets, and they're raising another 12 million in a, call it a Series C or Series D round, right? So that if they have 40, that 12 is going to put them over. It's going to put them over 50. So all the stock issued in that round is not qualified small business stock because immediately after the company has 52 million in assets, aggregate gross assets. So that's where that immediately after comes in and can cause a problem. The issuer has to use at least 80% of its assets in the active conduct of a qualified trader business. I'll move quickly here to the rest of these. Issuer can't have more than 10% of its assets in real estate not used in the business or in portfolio companies. They don't want an investment company disguised as QSBS. And then some other requirements down below, which are not more significant ones. And then if you meet those requirements, you get that benefit of the shareholder can exclude the greater of 10 million or 10 times basis. So the question is, what happened now as a result of OB3? Did it get better or worse? The answer is it got way better, much better. And so let's talk about the 3 major changes that came about from OB3. One is it increased that per issuer limitation from 10 million to 15 million. So it's now 15 million, the greater of 15 million or 15 times basis. And we'll talk about that in a moment. It created 3 exclusions. Remember I mentioned before you have a 5-year holding period. Now you can get by with a 3, 4, and a 5-year holding period. So there's a tiered exclusion percentage. It gets higher the longer you hold it. And then third, that 50 million aggregate gross asset threshold was increased to 75 million. So all of these taxpayer favorable things, but only apply to stock acquired on or after July 5th, 2025. So anybody recognizing QSBS 25, 26, and 27, most of 27, are going to be under the old regime, right? Because if you receive the stock on, call it July 6th of 25, you're not eligible for an exclusion for 3 years. That puts you to July 7th of 28. So that's the first time the new regimes, the first people selling under the new regime are going to be in July of 28 who met that 3-year holding period. So for everyone selling this year, 26, 27, they're going to be under the old regime. So meaning just the 5-year period. So I want to highlight again, these 3 changes only apply to stock acquired on or after July 5th, 2020. Very important thing. Sometimes people forget that. So I make a point of highlighting it each time. The exclusion applies the greater of a cumulative limit of 15 million or 10 times basis. So that's what the rule is now for that new stock. There's inflation adjustments too for the 15 million number. It's going to go up starting in 2027. There's a quirk in here, which is, I guess they needed to address it. Once you sell 15 million and you achieve that, you sell and recognize 15 million of gain. The fact that, say, the next year, that limitation 15 million, call it, goes to 15.5 million, that extra $500,000, you don't get additional limitation in the later years. Once you've used it up, you've used it up. In other words, they don't want you dripping it in every year. You always get more limitation. So once you use up whatever the limit is at that time, you don't get additional limitation in later years. So what's the planning tip? Like, what does these rules suggest? It suggests you should sell your older stock first. Right? Remember, when you do sell stock, if you don't sell all of it at once, you can designate, identify which shares of stock or blocks you want to sell first. The general rule is FIFO. If you say nothing, you can choose though to identify a particular lot of stock you want to sell under the basis allocation rules in 1012, section 1012. So you want to sell that pre-OB3 stock, which is a 10 million exclusion. Sell that first. When you sell the other stock, you get the 15 million. Second change, again, stock acquired on or after July 5th. We got these tiered holding periods. So if you hold the stock for 3 years, after you acquired on or after the 5th, hold it for 3 years, you get a 50% exclusion percentage. And I want to remind people, the remaining 50% is taxed at this penalty rate, the section 1202 gain rate of 28%, not 20% long-term capital gain. Plus you have the net investment income tax if your income's over 200 grand or 250, I think, for married filing jointly. So your effective tax rate here is 15.9%, right? So we think of it as you get some big exclusion, but it's not so great because you got to factor in this 1202 gain rate. If you hold it for 4 years, you get up to 75%. In 5 years, you get up to 100%. So it allows for earlier liquidity, right? You can sell earlier instead of the cliff at 5 years. You can sell earlier. Also, beneficial doesn't trigger an AMT adjustment like it did in the past. If you got your stock before 2010, there was a 50% and 75% exclusion period, depending on the year you acquired the stock. That applies under the old regime. That you were subject to an AMT adjustment. You're not for this new stock, so that's helpful. And so positive change for taxpayers who can take advantage. The 5-year rule, by the way, if you do sell now before 5 years, you get no QSBS benefit, but you can do what's called a qualified rollover under section 1045. So there's an ability to you sell your stock. If you reinvest within 60 days in another qualified small business, you can defer that gain, and then once you hit the holding period over the 5 years, you can sell and get the full exclusion you'd be entitled to. So there is that option as well. The third one for stock, again, on or after July 5th, the aggregate gross assets can't exceed 75 million, so it got more generous. Now it's for capital intensive startups that have larger asset base. They can issue qualified stock later times. And now you're getting into the Series B, Series C, D rounds. They can be eligible for the QSBS exclusion. Inflation adjustments also will be increasing this amount starting in 2027, like the 15 million amount. So the consequence, that 10x rule, or 10 times your basis rule, 10 times your basis, means your exclusion can be up to 750 million, which is a big number, right? And this usually comes up in the context of incorporating an ongoing business. So you're operating as a partnership, you incorporate midstream, and that's when if the company's worth 749 million, you can be eligible for this 10x basis rule and exclude up to 750. In reality, most people, when they get close, they convert well before the 749 number because they don't want to be fighting with the IRS. Were you worth 751 or were you worth 749? So it's up to 750 million. In practice, no one's going to hit that 750 million number. Or very, very few, if any, people will hit it. OB3 also allows you to expense. So remember that 750 million, 75 million AGA threshold is cash. Tax basis of your assets, plus if you contribute any assets, they're not less than fair market value. So you had to include capitalized R&E expenses gave rise to tax basis. So that could be included in the 50, now 75 million. OB3 allows for expensing, so that'll reduce the balance sheet for some companies that have a large capitalized R&E expense. And the last thing I want to point out is the immediately after requirement. 75 million must be met immediately after as well. Question came in on QSBS. Let's see. I'm sorry, I'm trying to understand the question. Deal. Yeah, so the question is, can you, if you're issuing stock to get over the 50 million, can you parse it into pieces? So if you're at 40 million, you're going to issue 12. Can you issue 9 first, and then a day later issue 3? The answer is no. The reason is a good question. I deal with this a lot. You can't do that because of the immediately after requirement. So the company has to have 75 million or 50, depending on when it's issued, right? In aggregate gross assets at the time of issuance and immediately after, which they don't define. Immediately after is not defined. Conservatively, 2 to 4 weeks. If you're beyond that, you're probably fine. But there's law in a different context that immediately after can be a year if it's part of a plan that was in existence. So in this case, if you intend to issue 12 million, even if you delay the extra 3 million for 3 weeks, it's part of a plan to issue 12. So deferring it intentionally is not going to help you qualify the first 9 because it's a part of a plan. The whole thing was, the fact that you teased it out over 3-4 weeks is unfortunately not likely to get you to win the day with the IRS. Okay, next thing we'll talk about. Thank you for the questions, though. Please keep them coming. They're definitely good questions. Next thing is self-employment tax for limited partners. A lot of movement in this topic. In fact, there was an article in today's New York Times about this. Scott Bessent, our Treasury Secretary, and now the acting commissioner of the IRS, was a hedge fund guy for many years, for over 20 years. And he availed himself of this self-employment exception. So self-employment, I'll talk about the article in a moment, what they said, which is interesting when you see the cases. What it is, it's level set for everyone first. It applies to net self-employment tax applies to net earnings from self-employment. So if you're a partnership and you work for the partner, you get a guaranteed payment. Net earnings from self-employment will apply to that. Self-employment tax applies to that. There's an exception, though, in section 1402A13 for the distributed share of income or loss of a limited partner as such, right? So that doesn't include guaranteed payments, which are payments for services. So the question is, do they intend to exclude all limited partners, or does that language as such limit it in some way, meaning only in your capacity as a limited partner? And in other words, are you trying to distinguish between compensation for services and distributive share return on investment? Or do you say, if you just as a limited partner, if you get anything, you're exempt, you're fine? The issue has been decided by the courts. It's on appeal. A couple cases are on appeal. I think the Fifth Circuit is expected to rule first, but it hasn't come yet. You have this Renkmeyer case from tax court in 2011. Sarban came out in 23. Sarban won another tax court case. And then what they said is that the statute says limited partners as such. It's not an automatic exemption for all limited partners. They're going to apply a functional analysis test to determine the extent to which the LPs are acting as limited partners or whether they're acting and getting compensation for services. So that functional analysis is trying to distinguish between true compensation for services and a distributive share, which is a return on investment. Notice saying return on investment. So you got to put money in to get a return on it. In May of this year, we had Sarban 2. So the first case, Sarban 1, I think was a summary judgment motion, if I remember correctly. But that's where they decided the law, where they said Sarban was a limited partnership. And they said the rule applies to limited partnerships. And if you're a limited partner, we're going to do the functional analysis test. Sarban 2, they went ahead and did that functional analysis test, which is why you see it came out as a TC memo. So the first case was a tax court case. TC cases generally decide novel issues of law or original issues of law, and so they'll come out with it's precedential. People can rely on it. TC memo case is when the tax court says we're not announcing a new principle of law, we're just applying the known settled law to unique facts of the case at hand. And so that's what happened in Sarabon 2, that memorandum opinion said they applied the functional analysis and they said the three limited partners of Sarabon 2 all worked 23 to 2,500 hours a year. They were actively involved in the management. Their skills were essential to the business. They advertised it as that. So for them, they said under the functional analysis test, it's not a return on investment. So the self-employment tax applies to them. It's a multi-factor test, a functional analysis test. No one factor is determinative. And so there's a bunch of factors. In the interest of time, I'll move on here. But I will say, so this article talked about Besant, Scott Besant, and there was an interesting quote. So the industry still takes the position that limited partners in LPs and LLCs are exempt from self-employment tax. You have these cases out there, though, and tax court cases. There's no appellate court cases, but tax court's binding on people, and so, but they're just not accepting it. So there's an interesting quote from a professor at the college, some tax professor, where she said, you have these cases that are out there, and you have the acting commissioner of the IRS and the boss of the commissioner of the IRS, Secretary of the Treasury, defying it. Right. And when it came up in his confirmation hearings and he said, I'm going to set a reserve, I'll set up cash aside to pay it if I have to, and she just notes that, there is case law out there. It's not like, it's not just the IRS's litigating position, or it's not just a revenue ruling that's come out. The courts have decided this multiple times now. And it's settled law in the eyes of the courts, as you see in this another TC memo case, Denham Capital Management, that came out last year. So the question is the partner getting compensation, or is it a return on investment? Did they make an investment? And in Denham Capital, there's an interesting quote here. They said, when the size of a partner's investment is relatively small in comparison to the income they earned for the services the partner provided, the small investment is not sufficient to classify the distributive share as a return on investment, meaning self-employment tax will apply. So you get into questions of, is a guaranteed payment enough that you're providing to the people? If not, then can some of that distributive share be recast as remuneration subject to the SET? And so these are the questions. It's an industry issue. People are waiting for they're hopeful that the Circuit Court of Appeals will reverse the tax court. So more to come on this. We may get it, may not this year, but we should expect a decision within the next, call it 6 to 9 months, 6 months to a year. Hopefully get a decision from an appellate court and get more clarity around the issue. Okay, next topic we'll talk about. I know we have about 17 minutes left, so I'll be sensitive to that. The employee retention credit. So I thought I'll give you a quick overview of where we are, the current state of the law, and then go into what came out in 2025, the guidance that came out this year in particular. So no new ERC claims can be filed anymore. That's long expired. 2020 claims had to be filed by April 15th, 24. 21 claims, 2020 and 21 claims had to be filed by 2020 claims had to be filed by April 24. And then they cut it off. The statute cut it off after January for Q3 and Q4, cut it off for Q3 and Q4 claims after January 31st. We'll talk about in a moment. There was a voluntary disclosure program 1 and 2. 2 they called the limited reopening. Those are closed. Taxpayers can still withdraw ERC claims that are unpaid or the checks weren't cashed. The IRS has a backlog of claims. They're still administratively denying thousands of claims. IRS can no longer assess tax on 2020 claims because the statute of limitations on assessment has expired. And they can't assess claims for Q1 and Q2 of 21. That also has expired. So 2020 expired in April 15th, 24. Q1 and 2 expired April 15th of 25. The IRS can assess taxes. OB3 extended the statute of limitations. They can assess claims for Q3 and Q4 at least until April 27th. What they said was the statute is now 6 years for Q3 and Q4 of 21. 6 years from the later of, I think it was the filing date, which is April 15th, deemed to be April 15th, 2022. So 6 years from that, which puts you at April 28th, or the later of that, or the actual filing date of the claim. So it can be many, many years to come for Q3 and Q4. Q4 is only recovery startup businesses, recall. However, there's this erroneous refund statute. And this says that even though they can't assess, they can bring a lawsuit within 2 years of payment. So not when you file the payments. If they paid the claim in 24, they got until 26 to go file a lawsuit. But this process is cumbersome. IRS has to, team up with DOJ. Both have to agree the taxpayer is not entitled to it. And then they have to file a lawsuit in court. So not just assess, which is a notation on the books of the IRS, but they need to file a lawsuit. So it hasn't been done in connection with the ERC, not likely to be done except in a large and egregious cases. Conversely, if taxpayer, their claim is denied, is never responded to by the IRS, as many are not, you have to wait 6 months after filing the refund claim, then you can file a lawsuit against the IRS. But if they do disallow the claim administratively, you only have 2 years. You must file within 2 years or get the IRS to agree to extend that time on a Form 907, which is an agreement to extend time to bring suit. The problem is there's no process to get the IRS to sign that, so you do need to have your agent get involved, or appeals, or maybe the taxpayer advocate. It seems to be the quickest way to advance that process. So what came out this year in March of 2025? The IRS came out with 3 FAQs, and then they came out with about a month ago some Q&A. So we'll talk about the FAQs first. This deals with income taxes in the ERC. The original rule was in the CARES Act, when it was passed, which passed the ERC originally, if you file a claim for ERC for 2020, you should amend your income tax return to pay tax on the amount of the ERC. And the way you do that is you reduce your wages in 2020 or 21 if you got the ERC in 21. So that's how they wanted you to do it, to go back and amend your return to reduce your wages, therefore increase your taxable income, and that's how you pay tax. So filed in the example here, you filed the claim in 2020 ERC claim, cost 21 or 22, and you got paid in 23. The IRS wants you to go back. You should amend your 2020 return to reduce the wage expense by $100,000, and the interest is includable in the year received. Right, so that $3,000 included the year received. They want you to go back and amend for the 100. The problem is the IRS paid so many of these claims after the statute of limitations expired. So if you're a taxpayer that timely filed your 2020 income tax return, let's just say April 15th or March 15th for 2020, you would have filed that in March or April of 21. So in March or April of 24, your statute of limitations expired. If you got paid your ERC claim after that, which many people did and some still pending, you can't go back and amend. That period's closed. So because of that, they came out with these FAQs to say, number 2 here, if you claim the ERC but didn't reduce your wage expense, and I would venture to say like 99+% of people did not amend their tax returns for to reduce the wage expense, and the reason made sense. The ERC is a relief provision for businesses suffering during the pandemic. To make people pay tax on that before you receive the cash is an additional hardship. Certainly wasn't the state, it was written that way, so someone intended it, but I guess they didn't think it through. But most businesses chose not to pay tax on something they didn't get yet. Okay, so if you claim the ERC, you didn't reduce it, then you get paid. What do? If you can't amend your income tax return, what they tell you to do is, guess what? Include it on your current return for the year you receive the ERC. So they're saying, but they're really admitting, we know we made a mistake. You can't go back and amend. So we don't want you to ignore it and not pay tax. What we want you to do is include it on the current year return, even though the CARES Act didn't say that. And even though everything we've said up until this point was you got to amend your prior returns. So a little bit of change of course here. The valid question is, can the IRS do this in the form of FAQs? Do they have the authority to do it? I don't know. I haven't researched it to give an opinion, but certainly it seems like they're overstepping a bit here. So they said the tax benefit rule requires this. If receiving the ERC claim is fundamentally inconsistent with the premise on which the wage deduction is based. So if you can't amend, you got to include it in the present year. So the example here is You filed your ERC claim, you got your 100 grand, you received it in 2024 after, right, November is going to be after the statute expired, so you can't amend. What do? They want you to include the full 103,000 on the 24 tax return because you can't amend your 2020 return any longer. So while they came out with this FAQ2, which, somewhat controversial, they came out with a helpful one in 3, which is some of the opposite scenario. I guess they wanted to seem even-handed and said, well, if you got your ERC late, but you did increase your wage expense, you're one of that, what I believe, maybe incorrectly, but if you're one of the less than 1% that did reduce your wage expense before getting the ERC, then what you can do is you can either amend, you can file an amended return or file a protective claim in which the year in which the ERC was received, right? So they're saying you can include it in the year received. So example is you filed your 2020 return claim, ERC claim in 22, you amended your returns, and now you pay tax on something you didn't get. In November 24, they disallowed the claim. So now you paid tax on an ERC claim. You didn't get the ERC claim, so what do? You got to get some benefit back, right? You paid income tax on an ERC, say 100 grand that they never received. So how do you get the benefit? They're telling you to increase your wage expense in 24. Because you can't go back and amend 2020, increase your wage expense in 24, which will reduce your income tax in 24. So you increase 2020, you never got the cash, you reduce your tax in 2024 to fix it, is the solution they came up with. So this is the opposite scenario where you got it late. Here you did deduct it, but never received the cash. Okay, in October of this year, so last month, the IRS came out with FAQs regarding to the OB3, that change in. They did a couple things with OB3 on the ERC. I won't mention all of them. Some of them relate to promoters of tax shelters, that kind of thing, and promoters of ERC claims. But what they did do is extended the statutes we talked about, but also said that if you have an ERC claim going back to Q3 and Q4 of 21, and you filed it after January 31st, 2024, and it wasn't paid by the time OB3 was passed, then that claim is no longer allowed. But if you were paid on that claim before OB3 was passed, they're not going to make you pay it back. So that's what they said in the legislation. And that date, January 31st, 2024, came from legislation that was proposed in, I think, January 15th of that year, somewhere around there. That never passed. So that it eventually came into OB3, but there was a proposal back in January of 24 to cut those claims off. And so that's where that date came from. So the IRS issued a bunch of Q&As just to implement the OB3 provisions about the this January 31st filing date. And the first one just summarizes the rule. The new legislation prevents the IRS from allowing a refund claim. They can't pay it after July 4th. Well, that's the 2025. That's the date OB3 passed. For Q3 and Q4 21 claims, if they were filed after January 31st, 2024, even if the taxpayer is otherwise eligible. So those claims are just cut off. Not eligible. So then you have quick Q&A 3, and the other Q&As just weren't that significant, so I didn't summarize them here. 3 says if taxpayer received payment on a claim before the OB was passed, then you don't have to pay it back, and the IRS, it's still a valid claim, you don't have to pay it back. So consistent with the statute. Q&A 4 says you can still withdraw those claims that were filed after January 31st, 2024 if you want. 6 says the filing date is the date you postmarked it. Nothing new or unique about that, but reminding people that a claim is deemed filed on the date it's postmarked in the IRS if it's properly mailed and submitted. Then Q&A, if the claim is denied and appeal rights are allowed. So if a claim is denied and you have an appeal right, the only issue you can contest is not whether the law is valid, but whether you filed it on or before January 31st, 2024. So if you said, no, I postmarked it January 30th, they deny it because they received it February 1st. So they have it tagged maybe as a February 1st claim, even though you mailed it January 30th, and they deny it. You can go to appeals and contest that, saying, no, I have proof that I mailed it January 30th. I'm not within this rule because I got it in on time. Okay, so that's the ERC. Let's move on to other guidance in the remaining 6 or so minutes we have. Election 83B, Finally, IRS finally, after years, came out with a standard form. Everyone had to write their own elections before. They had to prepare your own statement. It wasn't hard, but just unusual. So now they have this form 15620, came out in November of last year. Originally, you had to paper file it. Now you can electronically file it through the mobile-friendly forms portal, the IRS. So just helpful. The form's out there, reminding people it's out there. People got used to filing these things manually, creating their own forms. So a reminder that this form is out there. And it's got to be filed, remember, under Section 83B if you make the election. You need to file within 30 days of the grant of the restricted stock and provide a copy to the company. So the company's going to, because they're going to take their deduction at that point too. So it applies to restricted property or restricted stock and profits interests. Most people file an 83B for a profits interest, even though most are within the safe harbor. You don't need to. It's a protective election. So we see that most people do it protectively for our receipt of profits interests. Okay, qualified tips and overtime pay. This is another OB3 provision. Why am I discussing it here? I mentioned before that Lynn talked about it a week ago. She did, but some stuff came out, some guidance came out during the year, and I was covering all the guidance. So I'll briefly talk about it. The IRS issued November 5th a notice and a press release, which these are links. So if you get the slide deck, if you download it, you can click this link. All these things are here, are hyperlinks to the document. So if you hit Control and then click that link, sometimes you can access it that way if it doesn't work directly. But you can see it pulls up the site here, so you can access all these documents by clicking into it. The interesting thing about this is they realize that they haven't come out with guidance. Employers don't know what to do. How do you report this information to your employees? And they know it's not going to be done. So they came out with relief because they know that many employers don't yet have systems or data needed to comply with these new requirements. So what they said was very helpful in that you don't have to provide anything this year if you're not able to. No penalties if an employer does not include this extra detail, so long as you otherwise accurately report. So we're going to see in a moment a different position taken with the auto loans. But so employers don't have to do it. And W-2 forms will not be updated this year, but they will next year. Also, although it's not mandatory, the IRS is saying we do encourage you to tell your employees, give them detail about their tips and overtime pay so they can claim deductions, which makes sense, right? They're not all going to have this information handy. The employer is in the best position to provide the info. So they encourage you to give it, but don't make it mandatory. Also, proposed regs came out on tips. I won't spend too much time on that. But I do want to get into passenger loans, reporting interest for vehicle loans, right? There's another deduction for qualified passenger vehicle loans for 2025 to 28. This one's different. The IRS came out and said, lenders will have met their reporting obligations for interests if they make a statement available to the buyer indicating the total amount of interest received. So whereas in the other context, they said, you don't have to do it, we encourage you to do it. Here, you got to do something. So lenders meet their obligation if they do one of these things, put it in an online portal, in a statement or an annual statement, something. They want you to provide some info to the borrowers. I'll tick through the remaining things. I know we have 2 minutes left. I want to end timely because I know there's another speaker coming next. Borrow fees. So people borrow stock and then you pay the lenders for the right of their stock, called a borrow fee. The question is the sourcing of these for international purposes. They said it's going to be sourced based on the residence of the recipient, much like forward contracts and NPCs. So they issued a notice last month, 2025-63, announcing the rule. They're going to come out with regulations that come out with a residence-based source. In the IRS Office of Appeals, you can file administrative appeal within the IRS. They came out with regulations in January this year, they came out with final regulations saying, here we go, guidance on how to deal with the things appeals will consider. When you're in appeals, they won't consider whether a reg is valid under LOPR, right? Like they won't consider cases involving whether the reg, there's people want to say the reg's invalid. You can't. They said if a court said it's invalid, we'll entertain the argument. Otherwise, we won't hear it. And so these regs came out, which are helpful for if you're dealing with appeals. Paper checks, IRS is stopping paper checks for individual taxpayers. It's going to take time to implement. So I think we'll stop here. I know we have a bunch of stuff. There's futures contracts, a bunch of other guidance. The slide deck is available. if you want to look at it. Thank you for joining. I hope this was helpful. If you do have questions, please reach out to me or to Lynn Musensky-Keck, who did part one. We're happy to answer your questions, and thanks for being here.